All right. So, Rach, tell us in your experience well, first of all, the concept of a bridging loan, but then the downsides or the negatives of bridging.
Well, the concept of a bridging loan is that the bank actually has control. So the bank says, I'm going to hold the property that you have now. I'm going to refinance the mortgage you've got now. And then I'm going to finance the property that you're buying. And I'm going to hold that property deed as well. So I've got both deeds and I've got both mortgages. And you can buy before you sell, but I'm actually going to make sure you sell this property because you might not need to make the repayments during the bridging process, and that might be, 6 months, or they might even allow 12 months. But what's going to happen at the end is that house has to be sold, and if it didn't sell in that time, we can force that to be sold. And then all of the interest gets capitalised in if you're not making repayments, and then that gets added at the end.
So let's strip that back a bit for the first-time users here. Excuse me, too much pumpkin salad. The first part of that is the bank's got total control over your life right now.
Yeah.
They've got both mortgages or control over all of your lending, and they can pull the lever on it at a stage where you haven't sold that initial property, right? So is that generally a time frame where you say, look, you need to have sold your property within 3 months or 6 months or 12 months?
Some banks it's 6 months, some it's 12 months. But really, with a bridging situation, you don't want to be holding them for any sort of period of time. Because generally there's a risk involved. If you're buying at this time, what happens if the market goes down? You've already committed to this property at this level. You're selling over here. What happens if the market goes down?
So this first property that you own that's worth 800, you're now saying in a slowing market in the next 6 months, and we don't know what the future holds, could be now only worth 750.
Yeah.
So bank's okay with that. They take the 750 or like the sale, but you're 50K worse off, which has then impacted you on the other side. How is that 50K then added on if it wasn't factored into in the first place?
Well, then your mortgage at the end is just going to be bigger.
So what if your servicing doesn't suit that new mortgage?
So there wouldn't be a bridging loan approved without all these buffers taken into account. But what the bank will approve and what you've budgeted for are very different.
Very different.
So, you might have budgeted for this mortgage of $500,000 at the end and you're comfortable with that. But if you sold for less, even and the bank's, capitalising that interest in, you might end up with a mortgage of $600,000. Now, yes, you can afford that on the bank's calculators, but that's not what you budgeted for and that's not what you wanted. So I think there's more risk in buying before you sell.
100% there is. And it's a very stressful experience if you're not getting the sale you want in the desired time frame of that first property, especially if the market dips.
Yeah. So, these particular clients, again, they didn't have the option for bridging. If they did, I would have advised them against it because their budget really was, this is the end mortgage we want. And we don't want a mortgage bigger than that. Well, if you're really stuck on that mortgage, the last thing you want to do is go and commit to a property before you sell. So they ended up doing what's called selling before you buy. Now, what they did, this is the process. If you want to sell and then buy, it doesn't necessarily mean you have to move your family twice. It just means you have to be prepared to do that if the stars don't align. So what they did was they got a pre-approval. So the pre-approval is, okay, when I sell my house for $800,000, I've got a contract exchanged and I've got, a period of settlement before that happens. I've got an approval to go and buy the next house. And that's my end mortgage is going to be $750, let's say. So I've already got a pre-approval here for $750. So you have all of your ducks in a row before you sell your house.
Gotcha.
Everything's ready to go. So the moment that someone exchanges on your property, you can go and look. Now, when you're selling a house, in that first scenario where the buyer negotiated a longer settlement period because the standard was 6 weeks, these particular clients had control because they were creating, when you go to your conveyancer and say, can you please create a contract of sale for me to sell my house, they actually said, I want a 12-week settlement. So in the contract of sale, they put a 12-week settlement. Coincidence, they were both 12. But they said, I want to have a 12-week settlement. That way, when somebody buys my house, I've got 12 weeks. I've got 12 weeks to go and find another property, because I can't go and buy something before someone's actually exchanged and gone into an unconditional contract on my house.
All right, so we've got 3 scenarios here. We've got the first one of I sell my property and I buy another one and I have a simultaneous settlement, as in I buy one and sell one on the same day.
Yep.
There's more stress involved than that, but it's busy enough, isn't it? It's we're trying to do 2 things at once, essentially. The second scenario of I've got my property, I sell it, and then I've got some time up my sleeve to go and buy another one, but it's still a finite time frame.
That's right.
12
12 weeks is still a lot. So 12 weeks is a lot of time, but it's not really a lot, because the one that you go and buy is still going to have a 6-week, depending on the state, but let's say it's 6 weeks. So they ended up selling their property from the moment they exchanged. They already had their finance ready. Everything's ready to go. It only took them 4 weeks to find a property.
Right.
And it had a 6-week settlement. So really, the one they were going to buy the one that they were going to buy was going to settle 2 weeks later, but they organised a simultaneous settlement, because remember, they have control.
Yeah.
Before they bought this other property, they said, okay, we actually want 2 weeks more.
Yeah, yeah. So then the third option is I take a bridging loan, I buy something first, and then hope to hell my first property sells in a desired time frame where I'm not impacted.
Yeah. Now, for these particular clients, it all worked out and they also had a simultaneous settlement. But let's say it didn't. So let's say, what was the risk to these clients? And I think this is the really important part.
Yes.
If you're selling before you buy, when we sat down and work out what their risk is, what's the worst case scenario? You've sold before you bought. You're not going to, you don't find the property. They did, but there's many people that don't. What's your plan B? Let's have that in place. Are you moving in with family? Are you getting an Airbnb? Can you put your stuff in storage? And that was the plan they had. But for most people, having to move into their parents' house for 6 weeks is a lot less risky than having to get stuck with a much bigger mortgage because they've bought before they sold.
So they've bought before they sold, but they can still move into that property that they've bought?
No, they can still move into that property they bought. No, so what if they didn't find a property?
Okay, but the bridging loan is for when?
The bridging, if you got bridging approved,
yes,
that's when you can move in and you've got the 2 properties for a period of time.
Yes.
And you can market the other one at your leisure once you've already moved in.
Yeah.
But you've got that risk involved of you don't know what that house is going to sell for and you don't really know what your mortgage is going to be at the end of the day.
Okay, so let's park there for a little bit and say, right, I bought this property, I move into that property, it settles. All is well and good, but hang on a minute, I haven't sold this previous asset here. Now I've got to get on my skates and sell that property for a desired price. Otherwise, it's going to be impacted on my mortgage on the other side.
That's right.
Right. So what are the impacts? Like the banks don't do this stuff for free. So what's the premium that the customer's paying for a bridging loan?
So if you get a standard bridging loan with most of the banks, you're paying a premium because you're paying, let's say their standard variable rate, which is what a lot of them do. So let's say your rate today might be 6% for a home loan, but the bridging rate might be the standard variable, which can be 2% higher.
Right, so 8%.
So, but that's the cost. It's the cost of holding the 2 and the bank having control. Now, we have a lot of people that would come and ask us for bridging loans, but I would say there's a whole lot less that actually walk away with one.
Right.
Generally, there's another alternative, and that's why I thought I wanted to talk about some of these other alternatives because in this case, even if you could get bridging approved, it would not be recommended because really that mortgage at the end is important to you. Very different if you're a person without a mortgage and you're downsizing. And I feel like traditionally that's what bridging is designed for. It's really designed for the people who are downsizing and maybe not going to have a mortgage at the end of the day.
So are the banks out there promoting these bridging loans?
I don't think so. No, I don't think. I think they have it there in their suite, but I don't think there's different businesses that just do bridging loans. They might come with a whole lot of different fees though. Yeah,
because in the ideal world, like it's what sort of stress you want to put yourself under.
That's
as well,
right.
isn't it? Like, because you got to live a life. You might have kids. You might be working 50, 60 hours a week, you got other stuff going on in your life, and all of a sudden you're trying to buy and sell at the same time. Like in an ideal world, you'd say, right, I sell this property. I know what's actually in the bank. The money's settled. It's sitting there. I've maybe done a little bit of searching. I know what I want, but now once the money's there, I go and do that searching and then buy something within the next sort of 3 to 6 months. Where people, I suppose, vary from that is there's this gap in between. It's like, where do I live?
Yeah.
Is that fair to say that's the biggest concern?
And I think most people, their biggest concern at the start of that process is not wanting to move my family twice or not having somewhere to live.
Yes.
But when you actually really outline the risks of both scenarios, both ways, well, the risks on buying first tend to be a lot more.
Oh, higher, massive,
a lot
aren't they?
more. And it's just, it can be a really scary place. So I would say most people would sell before they buy. But then a lot of people don't understand, if you've never done it before, you don't understand that you can do things like have a longer settlement period.
Yes.
And you control that as the owner. You put it in your contract of sale and say, I want a 12-week standard settlement. You can have it anything you like.
Yeah.
You dictate when you're selling the property what the settlement period is.
Yeah.
So you can buy yourself time.
Absolutely. And my 2 cents worth opinion on this, because we're entitled to an opinion on this show, is don't let that short period of your life, that 3 months or 6 months where you have to find out where you're going to live and move the family twice and all that, don't let that be the barrier that stops you from doing things in a logical order.
Yeah. That is, a logical order is the perfect way to describe it.
Because it's just fraught with danger from a dollar's point of view, but also a stress level point of view.
Yeah.
I'm sure people are listening in now thinking, hell do I want to go through that process? Like I just can't even get my head around one purchase, let alone trying to navigate the way through two at the same time and deal with different agents and which conveyance am I talking to now? Is it the one I'm selling or one I'm buying or what am I doing here? Like it's just a lot to put yourself through.
And you can do a lot at the start. When you start the process, you can do a lot to sort of like reduce a lot of the risks that you have, which is longer settlement periods, making sure in that first scenario, making sure their house was completely ready beforehand. Imagine if they'd gone and bought that house, but then they started the process of getting an agent and getting their contract of sale ready. And then they found out their pool wasn't certified. Well, that was a 10-week wait. Imagine that. So it's just you can have all of your ducks in a row, which either way you go to make sure that you've covered everything before you start.
You can pivot, And the business owner side of me comes out and saying, well, if you are going to be up for this and put your life through it, finance-wise, you've done the maths. You maybe, if you're a partnership, husband and wife or whatever, you've got a partner there, you might say, right, one of us focus on the sale and one of us focus on the purchase, but align with what we're agreeing on both sides. And it's like, go off and do our own thing to get it done. I mean, it's just there's a lot going on, isn't there? But
there is.
You mentioned the settlement and we can be flexible with the settlement timeframes. Well, in theory we can, but again, really dependent on the market that we're dealing with because sometimes that's not possible. And we'd like to think, we can extend to 90 days and 120 days and people out there might want that. But the property you want, because we're talking about our upsizer, our dream home, really, aren't we? So that property that we really want is in a hot market and the vendor says, well, no, these owners want a 30-day settlement and I know they're going to get that because it's a hot market. So you offering 120 is just not going to fly.
100%. Now, in that first scenario where we had the loan approved in the background to be able to buy the two, now if the person who was selling the property had said 6 weeks or nothing, well, we'd already done the numbers on that. It was going to cost them about $4,000 in extra interest to hold those two for 6 weeks. Yeah. So do they want to get the 12 weeks and save themselves $4,000? Absolutely. But would they have cost themselves their dream home for $4,000? No. So it's about knowing all of those. What's it going to cost me to hold the two? $4,000? I'd love to do that. Yeah.
It just comes to me back to having a great mortgage broker in your corner to navigate you through the scenario.
Yeah, and I think, but if I could give, when people say to me, is bridging worth it? I generally say no. Yeah. I generally say bridging is like it's for very few. It's for very few that it actually suits. But I think a lot of people, what they think of bridging it isn't actually bridging. It's holding the two.
Holding the two, yeah, without paying the penalty of the extra 2% interest.
Or having the bank have control.
Yeah, and that's the other thing, isn't it? So I've heard of scenarios where the bridging loan has cost someone an extra 50, 100, 150K,
So have I.
right? Is that because not so much the fees from the bank, but the fact that they got less for their property that they were selling, or how has that
So here's something
out?
that I've seen happen. So I've seen this happen with a bridging scenario. So the agent had gone out and told this client that they were going to get, and I can't remember the figures, let's say it's $1 million for their house, and they've gone and bought another house for $2 million, thinking that the agent said they will get $1 million, no worries for their property. So they thought, that's really safe. I'm really happy with these numbers. I've got my bridging loan approved and I've gone and got that next property. Well, the marketing process starts and they're paying interest on the two.
Yes.
And then offers come in at 800. And they go, that's not what we budgeted for.
Holy hell.
Holy hell, what do we do? And you've got a choice then. And I always hear real estate agents say you get the best offer in the first 30 days on the market, because the people who, are buying your house are already looking, but they kept waiting. They didn't get their number, that the agent had told them this figure and they didn't get it, so they kept waiting.
Ooh.
But while they were waiting, interest is capitalising up. Well, they ended up selling for 800, but they ended up selling for 800 9 months later.
Right.
So they also had... so
interest.
it's 200,000 less than they budgeted for on their end loan. But I think there was something like 80-odd thousand in interest. So if they'd taken that 800 at the start of the process, it would have been very different.
Yeah.
But again, when you see these kind of big numbers, that's like $280,000 more on their mortgage at the end than they had budgeted for. Really getting an Airbnb for a few weeks because you're selling before you buy doesn't seem that big a risk anymore.
No. So the real actual cost is 280, but the actual out of pocket because of the bridging is 80. Like the 200s because the real estate agent fluffed them into thinking it was worth $1 million when it wasn't.
And generally, if somebody was coming, if you go to a mortgage broker and say, this is what I'm planning on doing, and the agent's told me I'm going to sell for this, well, generally they would get a bank valuation done. And I always say to people, take the bank valuation over the real estate valuation. It's really important to note that a valuer is qualified to value property. A real estate agent is qualified to market property.